Hello and welcome back to Ground Up Accounting. Now, in our last episode, Ground Up Coffee made its first sale on credit. We delivered coffee and pastries to a local architectural practice, raised an invoice for $220 and agreed to give the customer 30 days to pay. Now, there is something I'd like you to think about. Imagine you own a business and at the end of the month, you proudly realize that you've invoiced customers for your first month's trade to the tune of $50,000. That sounds impressive. But then someone asks, how much of that has actually been paid? Suddenly, the conversation changes because an invoice is not cash. An invoice is simply a request for payment. Until the money arrives in your bank account, that invoice remains nothing more than a promise. Most customers are honest and pay on time. Some pay a little later. And unfortunately, a small number, they never pay at all. Now that's why successful businesses don't just focus on making sales. They focus on collecting them. Today, our architectural practice settles its account in full, and we'll see what effect that has on our accounting records. 30 days have passed. Ground Up Coffee checks its online banking, and there's some good news. A payment of $220 has arrived from our customer. Now, let me ask you another question. Have we made another sale? No. The sale happened last month. The revenue was recognized when we delivered the coffee and issued the invoice. Today, we're simply collecting the money that was already owed to us. This is one of the most common mistakes made by people who are new to accounting. They think cash received always means new income. It doesn't. Sometimes it's simply the collection of money you've already earned. Today's transaction changes our balance sheet. It does not change our profit and loss. Understanding that distinction is one of the keys to understanding financial accounting. As always, let's ask the question we've been asking since episode 1. Which accounts have changed? First, our bank account has increased. We've received $220. That's an increase in one of our assets. Second, our accounts receivable has decreased. The customer no longer owes us any money because we've paid, or rather they've paid, their invoice. One asset has increased. Another asset has decreased. No revenue has been earned today. No expense has been incurred either. We've simply exchanged one asset for another. The amount we were owed has become cash in the bank. Let's record the transaction. So as you can see, in our bank, we're going to debit or increase the bank by $200. And on the other side, we're going to credit the accounts receivable $220, thereby reducing our accounts receivable by that amount. Now that's it, one simple journal entry. But notice what's missing. There is no coffee sales account, there is no sales tax account. There is no cost of sales account. Those were all recorded when the sale took place in episode 5. Today, we're only recording the receipt of cash. Imagine you looked only at your bank account. You'd see an extra €220 and you might think, great, we've made another sale. But that would be incorrect. If we recorded another sale today, we'd be counting exactly the same transaction twice. Once when we issued the invoice, and again when we received the payment. That would overstate our revenue and make our financial statements inaccurate. Accounting avoids that mistake by recognizing revenue only once, when it's earned. Receiving the cash simply settles the customer's debt. This brings us to another important concept: cash flow. Every business needs cash to survive. Cash pays wages, cash pays supplier, cash pays the rent, cash pays the electricity bills, cash pays also the insurance, etc. Profit is essential for long-term success, but cash keeps the doors open. You've probably heard the expression cash is king. Now, there's a great deal of truth in that saying. A business can be profitable on paper and still run into serious difficulty if customers take too long to pay. That's why successful business owners keep a close eye on both their profit and loss account and their cash flow. One tells you whether you're making money. The other tells you whether you have enough money available to keep trading. They're different questions. Both are equally important. Now that we've collected the money from our customer, let's update our financial statements and see exactly how today's transaction affects the chart of accounts, the trial balance, the profit and loss account, and the balance sheet. You'll notice something rather interesting. Some reports change significantly, while others don't change at all, and understanding why is exactly what makes accounting such, a powerful language for business. Our chart of accounts remains exactly the same. No new accounts have been introduced. We're simply updating the balances within our existing accounts. Notice how we're building our chart of accounts gradually though. We're only introducing new accounts when businesses actually need them. In our case, when Grand Upper Coffee actually needs a new account. That keeps our accounting simple, less complicated, logical, and probably, I would like to think easy to follow. Now let's look at our updated trial balance. So here we are, trial balance. We can see that our bank has increased. We can see that our accounts receivable is, it's back to zero, it's been cleared out. Now can you see what's happening there? That's very interesting to note. The rest of our trial balance is relatively untouched. And there we have it. Notice what has happened then. So in summary then, our bank balance has increased by $220. Our accounts receivable balance has fallen to zero, as I mentioned before, because the customer has paid in full. The total assets of the business haven't changed. We've simply converted one asset into another. Now let's look at our profit and loss account. You can see our sales revenue, less our cost of sales, less our operating expenses. There's our net loss. But note, something very important has happened. Nothing. The profit and loss account hasn't changed at all. And that's exactly what we'd expect. We didn't make another sale today. We simply collected money from a customer. Revenue was recognized back in episode 5 when we delivered the goods and raised the invoice. Today's transaction affects the balance sheet, not the profit and loss account. Let's finish by looking at our balance sheet. So our balance sheet there, under our assets, we have our current assets, note the bank. One thing, so look at that, the balance sheet has changed, but only in the composition of our assets. Accounts receivable has disappeared because the debt has been settled. Our bank balance has increased by exactly the same amount. So the total value of our assets hasn't changed. We've simply swapped one asset for another. Let's recap today's lesson. So collecting cash is not the same as making a sale. Revenue is recognized when it is earned, not when payment is received. Receiving payment increases the bank account. Receiving payment reduces accounts receivable. No new revenue is recorded when the customer pays. The profit and loss account remains unchanged. The balance sheet changes because one asset has been converted into another. Understanding the difference between profit and cash flow is essential for every business owner. Now, every episode is building another piece of the accounting puzzle, and by following the journey of Ground Up Coffee, you're seeing how real businesses grow and how their financial records evolve alongside them. Today, we've completed the journey from making a sale to collecting the cash. At first glance, it might seem like a simple banking transaction. But as we've seen, understanding when to recognize revenue is one of the fundamental principles of financial accounting. Our customer has now paid us in full. Our accounts receivable has been cleared, and our cash position has improved. In our next episode, we'll turn our attention to the other side of the business relationship. Just as customers don't always pay us immediately, we don't always pay our suppliers immediately either. We'll introduce accounts payable, learn how to record payments to suppliers, and discover how managing what we owe is just as important as collecting what we're owed. Thank you for watching. If you're enjoying the series, please like the video, subscribe to the channel, and share it with anyone who wants to understand accounting from the ground up. I'll see you in episode 7, Paying Suppliers.